Good morning, Chris. Thank you very much
Good morning.
thank you for joining me today on Montgomery Market News. Just want to introduce you. You are our Business Development Manager at 7IM. And we've been delighted to work with you over the last couple of years. And today I have the privilege of asking you a few questions, interviewing you a bit and talking a bit about the markets. So thank you very much for joining us. I just want
Sounds good. Thanks for having me.
That's a pleasure. That's a pleasure, Chris. I just want to firstly get your view on the global economic outlook and just thinking about what 7IM thoughts are as far as the next 12 months are concerned.
Sounds good. And a lot of noise at the moment. So hopefully I can spend some time to cut through that and give a bit of comfort to your clients as to why you're using a manager like 7IM. So good morning, everybody. Thanks for joining. To follow Katie's notes, the pleasure is all mine. A fantastic business to work with. I've enjoyed the time that I've spent working with Montgomery. So let's spend some time tackling that first question. I'm going to share my screen, so hopefully this works. Right. So, first question. The global economic outlook for the next 12 months. Now, 12 months is quite a long period when we're talking about markets, and a lot can happen in 12 months. You only have to look at year to date, where we were in January as to where we are now, to explain that. But we've tried to simplify it and put it into one chart for you to define what we think the next 12 months will look like. We've given it a name. So we say the next 12 months, we think it will be a sideways environment with volatility. Now, what we mean by that is the noise that is disrupting markets at the moment. We all know what that is, and we'll talk about that in a bit more detail. You know, manufacturing downturns post-COVID, where we're all going back out and spending our money on services as opposed to buying things on Amazon when we're locked in our houses. Inflation, and actually isolating that a bit further in the energy sector and in the petrol stations, and of course rate rises. All of that is leading to pretty strong economic data, but when you extend that over a period of time, or when we're talking about Montgomery estate planning, when we're talking about the life cycle of your client's plans, which isn't a one-year plan, it's 20, 30, maybe even longer than that years. The economic fundamentals don't actually change that much and aren't that strong. But of course, as we know, we're all human beings and we all live on emotional reactions. So any kind of data, whether it be positive or negative, can lead to a strong change or a swing in client sentiment. Good data can lead to greed and optimism, and data that we're experiencing at the moment, or the fear that may come into investors within investment portfolios, can lead to fear and pessimism, and that can affect markets. So just to extend that, what's causing the weaker economic data right now, and that's the brown circle. That's kind of where we are on this chart at the moment. You know, post-COVID, manufacturing downturns, the persistence of inflation, and central banks trying to combat that by rising rates. So a busy slide, but I'm just going to talk about a few of them points in a bit more detail as to what we think this means and what's happening in markets, and then leading on to what 7IM are going to do about it. So I've mentioned manufacturing. The 2 years within COVID, we saw 13 years of growth spent within 2 years. We couldn't go out, we couldn't spend money on the traditional things that we would spend money on as consumers within the economy. So obviously we were online buying things, and to produce supply for that demand, manufacturers obviously had to have a sugar rush or a boost to get them goods to our doors. And that was great, and that led to what some people might see as a strange environment where markets did well during that period, apart from, a certain period within March. And that was led by the fact that companies were doing well. People were buying things. Now we're in recovery. Now we're back to a relative normality. We're going back to spending things on what we used to spend them on. So we're out at the cinema, we're out spending our evenings at bars or nightclubs. Not me anymore. I'm well beyond them years. But
not me either.
As we can see that, as we can see that that has led to a manufacturing downturn and suppressed demand, which obviously affects the manufacturers and then growth companies within them. Another thing that's affecting markets right now, so inflation. We've had sort of 18 months now of bursting inflation. We think that it will normalise, but it may stay in this environment for some time. So if you look at what inflation actually is and how it's measured, core inflation, if we exclude the things that are affecting it right now, food prices, energy, that basket of goods, it's actually returning back to normal. And that's what the top right-hand chart is showing you, or at least it's coming down. Normal is probably the wrong terminology there. But you can't put core inflation, as we've stated here, into your petrol tank, and you can't use that on your energy bill. So whilst petrol and energy for the normal consumer is actually a small percentage of what we actually spend on a monthly or yearly basis, that is dramatically affecting inflation right now. In the bottom right, we can see the extremes. This is Germany wholesale energy prices and how they've spiked exponentially. So we know the story there as well. And that probably means that we're going to have a lot more monetary policy. So clients, or just people in general, be looking at the news right now and hearing noise about central banks rising rates. To put it into context, more monetary policy has taken place in the last year or so than in the last decade. If we look at it on a global level, over the past 200 or so days, there has been a rate rise every 2 days from a central bank. So that puts it into context at the moment.
Wow. And
of course, people see that inflation's high and central banks are raising rates to combat inflation. And of course, that brings in the fear of recession. Now, what is recession? Simplistically, people think of it as 2 consecutive quarters of negative GDP, but it is just a reduction in the global economy. And this is sometimes leveraged by central banks. Now, it does hurt in the short term, but it's leveraged by central banks to control inflation. And 7IM feel that central bankers will continue to raise rates until inflation becomes under control. But the obvious, back to our original chart, reaction to this is 2008, global financial crisis, recession, that's terrible. And that's not always the case. If we look before that period or any recession outside of 2008 of any relevant context, it's not necessarily a bad thing for the long-term outlook for the economy, but it does affect sentiment. And a simpler way to put this, as opposed to the charts that I showed before, brings it back to, well, what do clients do? So this all might seem scary, rates are rising, fear of recession, inflation, companies doing poorly, manufacturing downturns. So the alternative is doing what we've always done, which is keep our money in a bank account and just hope that our interest will get us through it. So again, pre-global financial crisis, that was okay. Here we're looking at £100,000 bank deposit. The plum colour, the bars on the chart here, is the interest you get from the money you've got in your bank. And the turquoise bars within the chart are the income you need to beat inflation. Or a more simpler way to put that is to make sure that you are actually making money year on year as opposed to losing it in relative terms based on prices rising. Now we're in a rate rise environment. That seems okay. That's good for savers. Keep my money in a bank account. You can probably see if you look on Money Supermarket, there's much better rates available for long-term savings account. But of course, we can see the turquoise bar higher than it's ever been on this chart since 1990. It's still not going to be enough to combat inflation. So there is a need to invest. We think that within this environment, with that need to invest and the struggles that portfolios might face, and if this data does affect equity markets, certainly in the next 12 months, back to your question, then 7IM's identity as a fund manager and somebody who sits within your solutions for clients can help clients in these environments, and we can discuss that.
Thanks, Chris. So can you tell me how are your fund managers positioning their portfolios in the light of the 12-month view?
Yeah, so I think you have to look at a few things here. There's what we're doing on the short term, and then back to what we said at the start of this, the long-term outlook for a financial plan. If we take it back a step, what are we actually trying to do for your clients? Okay, let's actually look at what 7IM are as a business, why we exist, and what we're actually trying to do for Montgomery estate planning. We're trying to provide strong investment performance. You know, preserve clients' capital. That's at the utmost importance to 7IM. It's why we were created as a business. It was created by 7 people who wanted to put their money in a company that they would be happy to put their family's money into. But of course, clients want to grow their capital as well and have steady inflation-adjusted growth. Now, we've delivered that over the long term, but of course, at the moment, that's challenging. Managing risk in an uncertain world, this is where 7IM really want to add value to you guys at the moment. So, you know, our job's to take risk on for clients, but manage the risk of what's happening at the moment and what I just discussed. And of course, with all of that, transparency and communication is absolutely key. During this session, try to give some context around what we're seeing at the moment and some comfort that clients can meet their long-term financial planning goals. So our identity as a manager, we are unashamedly conservative. So we've been in an environment where clients may have expected certain returns from portfolios, and we'll talk a little bit about what's generated them. But we are obsessed with risk management across our investment solutions, and ensuring that slow and steady returns is what's required. The journey is important to get you to your goals. Equal weight bias, so we don't like to have concentration within our portfolio to any particular areas, and we will discuss later on in the session why we think diversification is important, as I know it's one of the questions that you sent me. And we're not changing portfolios all for the same outcome. All the trades won't be doing the same thing. We're trying to think about markets more broadly, and not just allocate all of your clients' money towards a certain asset class. We're also anti-fashion, and we'll talk about this in a little bit. We think the environment we're in right now, and some of the things that I discussed, is very, very different to the last 4.5, 5 years, where clients would have been rewarded for just investing in perhaps a market tracker, especially the US, and riding the wave of what was pretty much a linear upwards curve. To bring that all together, we're here to make portfolios for your clients that are built to last with steady growth and peace of mind. So to bring that into what we're doing at the moment, now our long-term view doesn't really change. So I've spoken about what we think at the moment, which is sideways with volatility, but our long-term view, bringing it back to them beliefs, that long-term plan for the client and long-term outlook for your portfolio, there isn't much change. Our portfolios, we want them to be robust and they're diversified, talking about that concentration risk, not just in US equities. Okay, so we all know, or perhaps we'll read, you know, your Elon Musk, Netflix, your FANG stocks, Facebook, Amazon, Alphabet, Netflix, and Google. They have served clients very well who have exposure to them. But in the top right-hand chart, we've seen that downturn year to date and how the US market struggled. but we can see that the weight of them companies is still well over 25, 26% of the overall S&P 500. So we still think there's more pain to come there. We want to diversify across all markets and not just give your clients exposure to the US when we think that pain is still on the table. We also look at ways in bond markets, and we'll talk about, the traditional makeup portfolios where, okay, we've spoken a little bit about where equities may have some difficulty. So where can you take equity-like risk, but get a good return? And we look to things like high yield and emerging market bonds as opposed to government issued bonds, because they pay a better yield, around about 7% at the moment. That's more like an equity return that you would expect for investing within a company. And we will talk about our alternative exposure as well. So that's a big part of what we do and have done for some time. The traditional makeup of portfolios is challenged. 7IM for a long time has had exposure within your clients' portfolios to alternatives. And then we look at the longer term themes. So we think healthcare is an interesting area to invest some of clients' capital. Climate change, so we are reducing our carbon footprint within the makeup of our portfolios, and we are a ESG company as well. And we also try to give exposure within that alternative space to some of these markets, but taking some of the risk and volatility out of it by some of the alternatives that we use. So tactically, where are we at the moment? We're underweight equity risk, and we have a broader spread of alternatives within portfolios that have served clients very well. So to summarise that, the chart at the bottom shows our strategic asset allocation, the foundations, the building blocks, or the basket of asset classes that we put together for your clients, and whether, if we simplify them asset classes, we are underweight or overweight. And right now, we are underweight equity, but not necessarily for the long term, and overweight alternatives. Now, bonds, you see there, we spoke about them and the struggles. We are neutral on them at the moment. We need to remember that your clients will have exposure to existing bonds, but with rising rates, the issue of new bonds looks attractive, which is why that's our position there. But that is where 7IM are at the moment. And to summarise that, the next 6 to 9 months or so, we have a tactical underweight to equities, which works out around about 1% within the portfolio for a balanced investor. Now, of course, we're a manager that makes tactical calls within your clients' portfolios, or to put that more simply, create checks and balances on what's going on at the moment and not just stick to the long-term plan. And if equities have a sell-off, we will, of course, look to buy them. I've mentioned the long-term outlook and no change there, but at a core long-term view, we think that there's reasons to be optimistic for expected returns, and we're slightly heightening the risk over the longer term there. We'll talk about alternatives given that market neutral return, not affected by what's happening with bonds and equities. And we do absolutely believe that we're in a different environment to the last few years, and 7IM's investment identity will help your clients navigate that.
Thank you, Chris. Just before we go on to the next question, just in a couple of seconds, because I'm often asked this question, what does alternatives cover?
I'm going to go on to that right now. And it's a very, very interesting point, because I think from an investment perspective, people think alternatives, and perhaps I should have defined it. I knew it was coming later in the session. Probably think of hedge funds, probably think of spices, gold, wine. That's not what we're talking about, and I'll define that in a little bit.
Okay, thanks, Chris. So are you ready for me to move on to the next question?
Yeah, sure.
Great. So an equity and bond portfolio has traditionally been a sensible approach for investors, but obviously with bond returns reducing due to interest rates rising, how are you giving the downside protection in portfolios?
Alternatives is a simple answer. But yes, absolutely. So at the foundations of portfolios, why do you have equities and bonds within portfolios? Realistically, over the long-term view, having a purely equity allocated portfolio will probably deliver you, if history tells you anything, the best returns over the long term. But you've got to be able to ride that journey while you're doing it. And of course, within a financial plan, things can change, and the journey is important because you don't know when you're going to need that capital, and it might be within an environment such as now where markets are suppressed and all of a sudden you need to do something with portfolio. So there needs to be some protection based on your client's attitude to risk and capacity for loss. And that protection has historically come from allocating to bonds. So loaning a company or a government some money and getting a coupon. When markets go down, you get that free rate of return. But what we've seen is that equity and bond markets have almost been positively correlated. They're not supposed to go down together, but this is something we've been talking about for a time. Yields and rates coming down and down and down. Obviously, they're increasing now, but back to one of the earlier graphs, they're still pretty much at all-time lows, even though they're increasing. And that creates a challenge. So what can investors do? Well, ultimately, the foundations are still really important. Your building blocks, your strategic, long-term asset allocation collection of where your capital is invested is important. We spoke about making tactical changes and taking advantage of short-term opportunities and what markets are doing at the moment. And instrument selection using things like alternatives can help alleviate some of the pain that we've seen or that some clients have experienced by invested in multi-asset portfolios where bonds and equities have gone in the same direction. So back to your earlier point, what do we mean by alternatives? Well, what we don't mean is what you would think, property, oil, gold. Of course, these are alternative asset classes, but not what we're talking about within multi-asset portfolios. Crypto being the main one, right? So we've put that one on the end there because that's the thing that we're reading about in the news. Stellar returns, well, also stellar losses, and you've got to be able to stomach them. And long term, to get you to what's really important, what Katie and Ian and the team at Montgomery are providing for clients, which is getting you to your financial plan. It's all about protecting the downside and smoothing out that journey to meet your goal. So what we're talking about with alternatives is strategies within portfolios that are market neutral, that aren't impacted by what's happening in markets. So they can benefit from both rising and falling markets. And we're not just simply taking equity-like risk in another way or share-type risk in another way. We're actually investing in strategies that are almost isolated but delivering returns for your clients. So when we actually look at what a portfolio looks like, now you'll read in the news, multi-asset portfolios. If you Google 60/40, you will see plenty of articles talking about how that strategy has worked and why it's challenged at the moment. As a football fan myself, we think of it more as a 4-4-2, a combination of equities, making sure that you have your bond allocation in the right areas. I've spoken about that briefly, and some exposure to alternatives. The chart in the middle would have served you well in the environment that we've been in for the past 4.5 years. 7IM's view is the environment we're in right now. The chart on the right is how your clients' money should be allocated. And it's proven to work. So this chart looks at our alternative portfolio return versus global government bonds since the start of the pandemic. And you can see that it's delivered a return during a challenging few years where volatility has returned. It's made money in both falling and rising markets, and it has a strong presence within our client portfolios. Looking at that a bit more deeper and how we're allocated. So this is our asset allocated passive balance fund. This is what your clients will see when they look at their portfolio on their statement. Now, what we're doing is taking a lens and going underneath the bonnet and almost explaining to your clients why you invest in somebody like 7IM and in multi-asset strategies, because under the bonnet, they're extremely sophisticated and they will allocate your clients' money appropriately based on where that manager sees the best long-term value. And to pick that out, at the moment, we spoke about specialist credit. We don't just want to have exposure to global government bonds. We've spoken about the yields on offer, but not taking that equity-like risk within high yield and emerging market. And you can see in the middle, yeah, that we have them allocations. And then alternatives serve at 16, almost 17% of our portfolio exposure within a balanced client at the moment. And there's a multitude of things that we hold within there. Some of it is selling insurance on the S&P 500. So people want to buy insurance based on the volatility that they're seeing at the moment. Other things within there are things such as playing on the spread when there's a merger and acquisition for a company. Between the price that's announced and the price it actually gets bought for, there's value to be gained there. They're just two things to pick out. The key theme here is that this section on the right-hand side is delivering returns for your clients' portfolios in both rising and falling markets, and not necessarily being affected by manufacturing issues, inflation issues, and rate rises. It's proven to work. So 2008, you can see the returns that have been delivered from 7IM in these times of what is perceived crisis, and in COVID as well. And back to the overarching theme of what we've been talking about, long-term view. The first section I went through was our next 12 months overlook, and that's important to make sure that we navigate your clients through that, but the plan is long-term, 15 years plus. But to summarise, we think traditional asset classes are more challenged than ever. Bonds and equities, having exposure to government-issued bonds and investing in where equity markets are performing best, the US, is not necessarily the way to construct portfolios. And in the environment at the moment, your clients have two choices. They can accept perhaps lower returns from multi-asset portfolios, or perhaps tweak away from a traditional 60-40. And for us at 7IM, alternatives form a big part of that.
Thanks, Chris. That's really interesting. So what do you see as the main benefit for clients having multi-asset portfolios?
So we've spoken about this already, diversification being the overarching theme there, but don't worry, not many slides left from me, only 2 left. But it comes back to why we diversify. What's the main benefit of having multi-asset portfolios? The alternative is that you pick an asset class. We spoke about crypto, or you can just invest in property, or you may just go out and buy some equities on Revolut or wherever you can access them via a trade account. And that can be great. But as this picture really clearly details, this is the league table for what we class as the main asset classes of markets and how they've performed over time. From 2010 all the way up to year to date this year. And without looking at all of the left-hand side, if we just look at the 2 columns on the right, 2021 and year to date, and the black bars within there, you can see the change within 6 to 8 months that has occurred, and therefore the risk that your clients would be taking if they were to hedge their bets on one of them asset classes. What we have in the middle in the white boxes is 7IM's core foundation, strategic asset allocation, the building blocks of a client portfolio. And diversifying across this range of asset classes, you can see that over time it evens out that swing that you're having. We're going back to that orange bar at the first chart and not following the turquoise one up and down. We're trying to give your clients a steady journey that will get them towards their goals, reduce volatility, but take advantage of the upside and get them to where they're getting to with reduced volatility. That's why we think multi-asset funds are important.
Thanks, Chris. Just going on from that, when we talk about multi-asset funds, can you just comment on how often the funds are rebalanced? You know, what the decisions are on an ongoing basis, and how important it is to benefit from that.
Yes, absolutely. So the benefit of you as a business using multi-asset funds for your client is that, you know, going back to the slide here, at the top is what you will see on your statement. Underneath is what can happen underneath the bonnet. So we can change this over time based on what's happening in markets and how we see the world without actually a trade taking place within your client's portfolio. So at a baseline level, we realign our long-term thinking, that strategic asset allocation, that white box through the middle of that graph every year. We're actually going through that process right now. We then take tactical views on the world, what we spoke about within the first segment, our 12-month view, and we'll adjust portfolios accordingly on a tactical view. And we do that every quarter. But what we also have the ability to do is, in extreme conditions, do that at will. And we did that within Brexit when we made a currency trade. It was great for portfolios. And we've done that at other times during COVID where we took profits on our equity returns as well. So there is a structure to it, and strategy is fundamentally important to the success of your client's plan. But clients should take comfort in the fact that we also have the ability within these multi-asset strategies to adjust to what's happening in markets at the moment.
Thanks, Chris. So our final question then, so, what would be your advice to clients with investment portfolios today?
So one final slide to simplify this. This is a really interesting slide from a piece of research. Looking at your clients that you look after and where you, as an advisor, are spending your time delivering value for them clients. Okay, so back to the question of what would your advice be for clients with investment portfolios? To me, it's stick to the plan that Katie, Ian and the team have produced for you. Katie's plan is what's going to get you to your goals. Montgomery estate planning, know your clients' needs, know what they want in the long term and how you're going to get there. What 7IM do, this bar around the outside, is purely a vehicle to help you get there. So take the advice of your advisor, trust that they have done their due diligence on selecting the right manager, whether it's 7IM or another, but stick to the plan would be the advice. And look at the portfolio as a mechanism of getting you towards that goal.
Thank you, Chris. Thanks for your wisdom and insight. It's been very interesting to talk to you about the markets and about how 7IM are reacting to them and the strategies going on within the funds. No doubt we will talk again in due course.
Certainly. Thanks a lot. Take care, Katie.